If you've been watching the news or checking your investments lately, you've probably heard the terms bull market and bear market thrown around like everyone's supposed to understand them. But what do they actually mean, and why should you care? These aren't just buzzwords for finance nerds. They describe the emotional tides of the stock market, and knowing the difference can help you avoid panic during downturns and hype during booms. Let's break it down. A bull market is when stock prices are rising or expected to rise. It's marked by optimism, investor confidence, and economic growth. Think of it as the financial world's summer vacation. Everything's up, everyone's happy, and your cousin who just started day trading thinks he's Warren Buffett. Bull markets usually happen when the economy is strong. Low unemployment, rising GDP, and healthy corporate profits are common signs. You'll often see governments passing business-friendly policies, like tax cuts or infrastructure spending. Sometimes technological breakthroughs help too, like the rise of the internet in the 90s, which didn't just give us email scams, but also fueled massive growth in tech stocks. In short, when people feel like they have jobs, money to spend, and a shiny new iPhone every year, markets tend to climb. It's optimism with a credit card. Now, onto the bear market, the one people like to pretend doesn't exist until it's already halfway through eating their portfolio. A bear market happens when stock prices fall 20% or more from recent highs. It's driven by fear, pessimism, and often a slowdown in the economy. Picture it like winter for your investments. Cold, harsh, full of regret, and maybe I should have bought gold. Bear markets can be triggered by rising interest rates, surging inflation, political instability, or financial crises. For example, the 2008 bear market wasn't just about banks making bad bets. It was also about collapsing consumer confidence in a housing market built on dreams and duct tape. Even global events like wars, pandemics, or major trade disputes can shove markets into a bear phase. Basically, anything that makes people say, maybe I should just hold cash and hide under my bed. So why bulls and bears? The origin isn't 100% confirmed, but the most accepted theory is this. Bulls charge upward with their horns, and bears swipe downward with their paws. Also, Wall Street just really likes animal metaphors. Here's the takeaway. Bull markets feel great, but they can make investors overconfident. Bear markets feel terrible, but they often bring opportunity. If you don't panic, sell everything and start living off canned beans. Markets move in cycles. Knowing whether you're in a bull or bear can help you make smarter financial decisions, or at least sound impressive at parties. So next time someone says, the market's looking bearish, you'll know it's time to stay calm, stay smart, and maybe avoid any sudden moves, just like you would with a real bear. Thanks for watching. If this helped, give it a like, and subscribe to Modern Finance Lab for more no-nonsense money insights with just a touch of sarcasm.